And I think part of, being a really astute, successful business person is the ability to have an open mind to be convinced to things that you might not have thought were the way to go from the beginning.
Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe that the key to scaling your business and compounding your wealth starts every day with a mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal to help you scale and compound your wealth and life so you can give more or all of it away to help MVPs. I'm your host today, Brett Swartz. In every episode, we feature some of the world's top entrepreneurs, millionaires, and billionaires. They share their principles, values, secrets, and wisdom, providing each of us with the insights we need to reach the next level of faith, success, and impact. I'm excited about our next guest. He is out of the state of California. He's actually a strategic alliance of capital gains tax solutions, and he's the founder of Praxis Capital. It's a vertically integrated real estate and private equity investment firm, which he founded in 2001. He's a member of the Praxis Investment Committee. Praxis operates on multiple platforms, currently managing active syndications and acquisitions of single-family, multifamily, and opportunistic residential assets in U.S. growth markets. He has acquired over $800 million worth of real estate over a 30-year career, including over 4,000 multifamily units. He also scaled a lending business from zero to over $1 billion worth of loans. So much more. Please welcome to the show with me, Brian Burke. Brian, how are we doing?
Yeah, I'm doing great. I'm just glad to be here. Being on a Build It to Billions podcast means I'm on the right road.
Absolutely. We're all on the journey together, right? And some of us are further ahead or a little bit further behind. But for our listeners getting to know you for the first time, would you share a little bit about your story and your current focus?
Yeah, my story started out, right after high school as a house flipper and kind of like cobbling together however I could make it happen. I grew that business into a multifamily investment business where I was buying apartment complexes. I've been doing that for about 20 years. Built a lending business about 7 years ago that I exited 2 years ago. And it's been an incredible journey, Brett, and you've been there to see a lot of it along the way. But this is a fun business, and I really enjoy what I do.
Absolutely. And we love Brian Burke, by the way. He is also an author that you want to check out his book by going to praxcap.com, praxstops.com. It's The Hands-Off Investor. And we're going to be touching on some of those principles that he's learned along the way. Today, we're going to be talking about basically scaling from millions to billions in valuations for loans, but also just kind of scaling businesses, evaluating sponsors, evaluating real estate. Brian has a wealth of knowledge that we're going to be talking about. And so, Brian, I want to start with that. The lending business, right? That in 7 years or 7 years ago, you started it and you were able to exit. And I think at the height of it, you guys did over $1 billion worth of loans. So just talk about the top, one or two secrets that you were able to scale so quickly and so efficiently, and also be able to exit in a way that made a lot of sense for you at the time.
Yeah, when we first started that company, we thought maybe we'd do like $30 million of loans a year, and then we were doing 130 million a month, by the end of the fourth year. So we did 2 billion in loans in the 5 years that we had that company, and 1 billion of that was in the fifth year. And of course, that got us noticed, and somebody really had to have it. So far be it for me to keep it from them. It was time to sell. But I think building a business like that comes down to a few key things. One is having the right product for the market, and what we were specializing in was fix and flip financing, small balance, multifamily financing, those types of bridge loans, which are really needed by real estate investors. And that, is a product that we knew very well because we'd been on both sides of this, right? We had been lenders, we had been borrowers, we had been house flippers. So I think part of it is being in a business that you know from all angles. And another part of it is just having really good, solid partners. I couldn't have done that business on my own, just by myself. I had two incredible partners that had skill sets that I didn't have. So between the three of us, it was a really well-rounded company. And as you can, as history will have proven, when you have really well-rounded management and a well-rounded company and a great product, you can have a very successful business.
Okay, so I'm hearing a couple themes there, right? You had extensive, by that, I mean literally like hundreds and hundreds and hundreds of homes, fix and flip, loaning, selling, lending to, developing, all of that. Also, 4,000 apartment units along the way, right? So this isn't something where you just said, "Oh, someone to do this." Like you guys had intimate knowledge of every aspect of real estate, and then you said, "Okay, number one, number two, we have the right product." In fact, you didn't actually even know maybe how much of a gold mine it was until you're in it. But then all of a sudden, you're like 30 million is what you were thinking you're going to be able to do, and you started to do like 130 million a year, and it started to go crazy. Maybe a month, you said something crazy there, which was really cool. But ultimately, it came down to partners, right? You had a couple partners. How did you know? And first of all, is that a fair summary? And then dive into the partners. Like, how did you know that, like, A, these are the right partners? This is the right way for us to approach the roles for this business?
Yeah, you did summarize it right. We did think we'd do 30 million a year, not 130 million a month, and that's what it turned out to be. It really became quite an incredible business. And I had flipped hundreds and hundreds of houses, about 600 or 700 houses when we started that company. One of my partners had flipped, at least 1,000 houses, so he really knew the business as well. And of course, that meant that we had been borrowers of this kind of money in the past. That makes a big difference because when you know what your customer really needs and wants, you can provide the right thing for your customer. Your customer in this case being the borrower. And then our third partner had tons and tons of lending experience in institutional underwriting, banks, all that sort of stuff, and brought that capital markets experience to the team. And it's just an interesting thing. Actually, the one of my partners was one of my lenders and came to me with this idea of, like, he knew I was a great borrower and knew that I had a lot of house flipping experience and that this was a product that would be marketed to house flippers. And it's just funny how life works out that way. You never know, when you're building one business, you never know what strategic relationships you form in the course of that one business that might lead to other business opportunities down the line, even when the person that you're in this relationship with is a service provider. It might not be that, it's a partner of yours or somebody you meet at a conference. It might actually be somebody that you're buying products from, which is essentially what I was doing when I was borrowing, would be the person that could help spearhead your next incredible business venture.
Wow, so much wisdom there, right? And also, I think that's key, right? You're already doing business. They're already doing the business. They are experts. You guys are each bringing, like, one institutional lending experience, right? And the other one, 1,000 houses. You 700 to 800 houses. All of this, I feel like it's a dream team, right? In a sense, like you really don't want to settle for anyone that's not on the dream team, and that you can bring together and collect. Because I mean, partnerships aren't easy, right? I mean, things can fall apart. Things can go wrong. Like talk about, maybe even some of the lessons that you guys had to work through as you're scaling so fast, right? And it's going full steam. What wisdom can you give as far as like having tough conversations to adjust roles, responsibility, vision for the company, and then move into like ultimately like when it was time to sell? How did that all come together?
Yeah, building a company like that requires a lot of help. It's not something that you can do just by yourself. It's not even really a task for a couple of well-skilled partners. I mean, this is something you need a full team for. And, we had to have a lot of conversations about what roles needed to be filled. We would have an all hands conference call amongst the partners every single week. And each week it would be like, okay, what role do we need to hire for this week? By the following week, we need to have A, B, and C in place. And, that means going out and finding really top performers, A players. And, we were hiring people that would cost multiple hundreds of thousands a year in compensation to get the kind of A players that you need to build a business like that quickly. And those are difficult bridges to cross. When you think about setting up a new business and about how much revenue you have versus how much expenses you can afford to have. And then, of course, the other challenge comes when COVID hit and essentially shut everybody and everything down. And now it's like, okay, do we shrink? Do we lay everybody off? How do you navigate these kinds of challenges when really nobody is doing much of anything? for several months. And so that was a difficult period, but it's amazing how quickly we got through it and how quickly we recovered, and then how the business grew exponentially after that event. That had we just said, all right, let's lay everybody off and go crawl under a rock for half a year, we wouldn't have been able to have captured, the upside on the backside of that.
Wow, so cool. And what I'm curious, like what as the partnership's progressing, as you guys are building, as you're scaling, as you're finding all this amazing talent, as you're investing to these people that cost a lot of money to bring on, but you keep pouring into it and it keeps compounding and building and building and building. What what was I guess the biggest challenge that you feel like you had to overcome as a leadership team collectively? Like, what about it besides just finding the right talent and bringing them on board? What did you personally or as partners that you guys have to grow through? Because I feel like growth from 0 to millions takes a certain set of skill sets, but millions to billions is a whole nother one, and that's why we're on this journey on this podcast to kind of figure that out. But what was the one where you said, "Wow, I really got to level up here," and then what did that look like for that plan for you? I'm curious.
Yeah, that moment really was the COVID moment. When everything got shut down, you would say like, well, you can still flip houses, right? But people weren't. I mean, there was a period where like everybody was on full stop. Everybody was hiding in their houses. Nothing was happening. And, we had an office with a lot of employees that we had finally just finished building this. We started in what, 2017. And, we had by 2020, we had built up a really, we had a lot of square footage. We had a lot of employees, and now they're telling everybody to stay home and you can't come to work. And, how do you continue to build and grow a business when people aren't under one roof to be able to collaborate on how that's going to happen? So we had to, it was a lot of challenge in, well, first of all, just how do you even stay afloat? uh, what's your burn rate look like versus revenue, and how long can you outlast it, and how long should you try to outlast it? And I think in March of 2020, nobody knew if this was going to be a 2 week deal or a 2 year deal. And it turned out to be somewhere in between. But we decided that the best thing for us to do was to sit it out. So we started having people work from home, and we figured out how to draw loan docs and do all those things from, remotely from people's houses, and keep everybody. We didn't lay off a single employee during that period of time. And some would have said that we should have, but I'm really glad that we didn't, because really about 2 or 3 months later, things started to turn around for us. And that's when our growth really started to take off. But it's difficult introspectively to think, how do we get through this without bankrupting ourselves?
I'm curious, was there tough conversations between the partners? One saying like, just get rid of the fire sale in the sense of like, just cut the expenses, cut the employees, and then you had the other side like, well, maybe somewhere between. I imagine it's not that extreme, but like, what were those like leadership conversations, and how did you best work through those with the partners?
Yeah, I was really fortunate, Brett, that I had some top quality partners. I mean, I think this is one of the things that where some businesses struggle is there's two issues that come up with partnerships. One is that you partner with yourself, and I don't mean that in the literal sense. I mean it in the figurative sense, that you find a partner that's you. They think the way you think. They would do the same thing you would do. They know the same things you know, and that's why you pick them. You're like, we agree on everything, so I'm going to pick this partner. But they really don't add anything to the equation other than just, another 24 hours of labor every day. Because, you want to have partners that know things you don't know, that have experience that you don't have. So that means picking somebody different than you. So that's kind of one problem that people run into in partnerships. The other is that they have partners where there's personality clashes and conflicts, where the partners just argue with each other. They can't agree on anything. If it's a 50-50 partnership, it's a real disaster because there's no tiebreaker. This is where having three partners is great, because you can have a 2 out of 3 vote to make things happen. And that's our situation, is we had three people, so we always had the 2 out of 3. But the real sweet spot for a partnership is to find partners that are different enough from you that they bring different experience and different skill sets, yet alike enough with you that you don't disagree on everything, and that you can make management decisions, and generally you're going to make management decisions that are similar. And at least if they're not, you're going to be able to work through it and agree on, what course of action is going to be best. I was really fortunate that my two partners were absolutely top-notch guys. That I wouldn't say we were like agreeable in the sense that we just go along with what everybody says, but it just happens that we all had a very good, strong business mind, and we all kind of came to the same conclusions on all these major decisions as to what the right thing to do was. None of the three of us were like an outcast saying like, no, we really shouldn't do that, and I'm going to hold my ground, and then you have this conflict to resolve. We fortunately didn't have any of that.
Oh man, so much wisdom right here. I'm going to pull out a couple nuggets, or just kind of dig in a little bit more. You said a couple things. You said, I like enough that you don't have like such huge clashes, right? I'm wondering if so I click of values and I think of how, right? Values and how. Like you might have, different experiences, different knowledge, different skill sets, right? And some of the clashes or some of the disagreements could be on, hopefully, cannot be on values. If values are not aligned, if they're not, the core values aren't consistent with one another, the whole thing's going to be building a house of sand. It's going to fall apart. But the how is the part, like, how are we going to best get there? Seem like that would be like more of the potential disagreements that would come up. So was there anything about the how that you guys kind of had to work through? And then there was a 2 out of 3. Was there ever one of those? I'm just kind of curious because I think we learn most in the conflict and the challenge of growing through that. Was there ever a 2 out of 3 situation where you're like, okay, I had to give in, or they had to give in?
We never had a 2 out of 3, surprisingly. I mean, all the 5 years that we did that business, there was never a time where there was one holdout saying, "No, we shouldn't do this." The other two was like, "Well, we're overriding you." We all, and sometimes, you come into a conversation thinking like, "Well, maybe we shouldn't do that." And they have this idea and you're like, "I'm not so sure." Then it wasn't really like, "Okay, outvote me." It was more like, "Tell me about how that would work." And what are we going to do if A, B, and C were to happen, or if A and B didn't happen and only C happened? And then I could get educated on why they were thinking the way they were thinking. And usually, you go like, what, that makes total sense. I didn't even think of it that way. You guys are absolutely right. And I think part of being a really astute, successful business person is the ability to have an open mind, to be convinced to things that you might not have thought were the way to go from the beginning. Now, certainly it doesn't mean that you have to be a yes person. There are times when you have to stand your ground and say, no, this is really what I feel. But you really have to be open to hearing other perspectives, and just kind of evaluating when those other perspectives have a point that you wouldn't have even thought of.
So much wisdom. We're talking with Brian Burke here. You can find more about him by going to praxcap.com. That's praxcap.com. And he is the author of The Hands Off Investor: Discover the Secrets of Passive Real Estate Syndications. He is a strategic alliance with Capital Gains Tax Solutions, one of the top groups that we have invested with in the past for multifamily syndications for lending. They've done an amazing job for us. So, Brian, I think there's so much wisdom and everything here. I want to kind of wrap up the partnership part of this talk with this piece, which is when it came time to sell, right? And so I think part of being listening is listening to the marketplace, right? Listening to investors, right? You, before your profession as a home flip and syndicator, you were a policeman, right? And so you had to learn how to discern, right, quickly in high pressure situations. So talk about your ability. I feel like it's you're probably one of your top gifts for sure, right? To be able to listen and discern, and then to take decisive action when the timing makes sense, right? And of course, we're not always going to get it right as investors or as operators, right? But in particular, the sell part of it, right? You're like, whoa, okay, we've just went from 30 million a year, we thought, to 130 million a month, and now it's time to exit. Walk us through how that all went down.
Yeah, well, I'll tell you the timing was absolutely perfect because we closed on that sale literally like 2 weeks before the bottom fell out of the lending market when interest rates started to go up and up and up. So we literally couldn't have timed it any better. But it really wasn't so much that we were timing it. It was that, we got an offer we couldn't refuse. Now, certainly we built the company with the idea that someday it would be marketable. We had an investment banker that we were in relatively regular communication with to say, like, is anybody looking for this kind of company? If they were, what would they be looking for? What kind of multiples are you seeing in the market? So we were always kind of keeping our eye open for what the prospect of a sale might look like. And as it came to fore at one point, just out of the blue, the conversation was like, "Well, yeah, we actually know somebody that's looking for exactly what you guys have right now." It just didn't, in passing through one of these conversations, and they're like, "Well, bring us an offer if it's what they really want." And ultimately they did, and ultimately that offer closed. And so sometimes it's you really work toward timing, and sometimes timing just comes your way. And again, it comes back to always being open to possibilities, just like I was saying earlier in this podcast about when you're talking to service providers and strategic connections, you just never know who's going to be the hold the key to unlock the next gate for you. And this was the same kind of situation where we were always out there to talk to people that might have keys to gates. And as it turned out, it worked out.
Absolutely, so great. I feel like you read a whole book on that, and you listened and you went for it, and the timing couldn't have been better for when the market fell apart. Um, so now let's take it down to where we're at right now, right? So and of course in the hands-off investor as well, you're also looking at wisdom for evaluating sponsors, evaluating real estate. So for the listener out here who has the millions, right, and they're building it to billions, and they're looking to maybe trust, they're looking at, hey, if I'm going to scale this thing, I need to invest or even invest even more to a third party group like a Brian Burke Praxis Capital to scale. Like, what does that look like? What are some of the questions they want to when evaluating sponsors and evaluating real estate?
Yeah, well, evaluating passive syndication opportunities is really an exercise of outsourcing your real estate investing to someone else. That's what the whole process really is. If you've got some personal wealth and you're looking to invest in real estate, you could go out and just buy a rental house, buy an apartment complex, buy a commercial building, a strip mall, any of those kinds of things. You could do that. You don't need any help with it. But a lot of people that are in that situation and have that capital to invest have that capital because they have a very successful business already, and they don't have time for the distraction of investing in real estate, but yet they want to have real estate exposure in their portfolio. So investing in passive syndications is a way to outsource that real estate investing to someone that's in the business of real estate investing instead of building yet another business to do something other than what your primary business does. You just simply outsource it. So, as with any other search for an outsourcing partner, it really comes down to who you're in business with. And a lot of people tend to think that investing in a passive real estate syndication is all about the real estate. So, and the way I can tell this is they'll ask me the question. They'll say, "How do I find one of these deals to invest in?" And it's like, that is the wrong question. You're not looking for a deal to invest in. You're looking for a sponsor to invest with, and they will bring you the right deals to invest in. So think about who is on the other side of this transaction. What experience did they bring? What track record do they have? How can you prove that they're honest and trustworthy? Because let's face it, this is hard-earned money you're investing, and if you can't trust the person that's in charge of it, that's going to be a real problem, no matter how good the real estate is.
Okay, excellent. So really the key, the mindset here, it sounds like, is you really want to be looking for the sponsor. And also I think back to the keeping an open mind, right? For where these opportunities can come from. However, the track record has to be there, right? And they have to be someone that instead of looking for instead of starting a business all by yourself, or at a certain point, baby boomers are listening to this podcast, right? They're like, I have been that sponsor. I have been that operator, right? And now I'm ready and need to either health or circumstances or just time and energy. They want to harvest their wealth, and then they want to have it planted in real estate, but they don't want to necessarily be the farmer out there who's having to cultivate, right? And so this transition between wealth to the next generation, I think, is a big part of this as well. And I think a lot of the entrepreneurs and the real estate folks that we work with, they made their wealth in real estate and business. They made it on themselves. So talk to the one who's having a tough time, giving up some of that control, right? And trusting that sponsor to do what they say they're going to do. Walk us through, some questions to help them, get over that.
Yeah, that's a really difficult thing because, an active real estate investor is used to being involved in the day-to-day selection of the property, property management, choosing, property managers and, looking at the financials every day. And then transitioning to a more passive role is a little bit uncomfortable for a lot of active real estate investors. And I look at this situation myself. I mean, am I going to still be out chasing down real estate when I'm 80 years old? Or am I going to want to outsource that to somebody else and still have real estate in my portfolio? So it's really it's a transition from active investing to passive investing. And this is where, the 1031 exchange is a way, that people defer tax because they're remaining active. And one of the things that, your company at Capital Gains Tax Solution does is it allows people to make the active to passive transition and still defer tax in some way, because generally when you do a 1031 exchange, there's no way to get to passive. As soon as you convert from active to passive, you're paying the tax on all the gains that you made as an active investor. And so, but it's still a transition that everybody's likely going to have to make. I mean, you could invest in real estate until the day you die, I suppose, and everybody could do that. But who wants to? I mean, at some point you want to retire and kind of go out and just enjoy life, but yet you still know that real estate's been good to you. So you want to look for people who share your philosophy and beliefs in real estate investing and how to manage risk. One big thing you see a lot of out there is that sponsors are so focused on returns. It's like, this is the IRR I'm going to get you. And investors get so zeroed in on, oh, well, what's the highest return? And who's having the discussion about, well, what kind of debt are you putting on that property? What's your loan to value ratio? When does that loan mature? And it's like, oh, by the way, this is 90% loan to cost bridge debt that's going to mature in 3 years. And that's an extraordinarily high risk investment. So I think that when people are converting from active to passive and they're going to go into a real estate syndication as an investor, they need to look at the skill and track record of the sponsor. They need to look at how that property is being financed. Are those returns being leveraged or engineered by using excessive levels of debt, private or preferred equity, multiple share classes, and all kinds of different ways to juice returns by adding risk? And you need to think about what your risk adjusted return really should look like, because the last thing you want to do after working all your life to build up a big nest egg is to lose it all with some yahoo out there that's just willy-nilly financing all the way to the hilt and taking on all kinds of risk on your behalf.
100%. Such wisdom right there. Rewind that and take those notes. These are the key questions. And I talk about tax flow, cash flow, and debt flow. And debt flow, I feel like, was the one that we took for granted because interest rates were so low. And those who didn't manage and look at risk with debt are in a tough spot. I mean, I guess they say, who could have thought that the interest rates would jump so high so fast? But at the same time, it's a reality of what's happening right now. Thank you also for plugging Capital Gains Tax Solutions. If anyone wants to learn more about how to defer capital gains taxes not using a 1031 exchange for businesses, Bitcoin, real estate of any kind, stock, you can go to capitalgainstaxsolutions.com. It's a great way to be able to be active, like Brian says, but then be passive and diversify it into multiple real estate syndications or funds. It can be going into debt, it can go into development, and you can diversify back into different asset classes at any time. Just go to capitalgainstaxsolutions.com to get started. So, yeah, I like that transition from active to passive. And you're right, at a certain point, we're each going to face that. Let's get kind of narrowed in on today's marketplace right now when you're evaluating deals. Brian, where do you feel like we're at right now? We're a couple months from the election. We're recording this in mid-August or so of 2024. What's your take on just opportunities, sellers' expectations with value, and being a buyer of? Let's just talk about multifamily right now, 100 plus units, value add. Like what's kind of your feeling of this right now?
Well, I've been a pretty outspoken market bear and pessimist for like the last at least couple of years. In 2021 and the first half of 22, I sold three quarters of my multifamily portfolio. And I couldn't have timed that much better, I don't think. It was, we got out right before the market started to really drop. By my calculations, peak to trough market values in multifamily have moved over 35%, which is a really deep, deep move. Now that's peak to trough. Peak was very short. The peak was probably the first two quarters of 2022 is when pricing peaked out. Trough is kind of where we are right now. And so I haven't bought any multifamily in 3 years, and I don't know how long it's going to be before I do. I don't want to ride the market down. I want to ride it back up. And I haven't received any proof yet that we're at the bottom where a ride up would start if I were to get in today. Although I do think we're getting a lot closer. If you would have asked me this question a year and a half ago, I would have said, I don't know, we're maybe 6 months to a year out, maybe 2 years out. Now I think I would say, we're 6 months to a year out and probably not 2 years. I think uh, somewhere in the near future, we're going to see a market bottom. We're going to see uh, better conditions for buyers to buy, maybe worse conditions for sellers to sell, frankly. But that's been kind of one of the things that's been hamstringing transactions over the last couple of years has just been seller expectations have been too high. They want values that today's borrowing costs and lack of rent growth are unable to support. And that's why I've been outside of the market for as long as I have been.
Yeah, it makes sense to me. It's just the negative arbitrage, right? At a certain point, if you have good, fixed rate debt in place that's still lasting another 2, 3, 4 years, what is it? It's hard to make sense of selling that and then going into a higher debt position and a negative arbitrage because it does seem like cap rates are still not going as fast as we think it would go. 35% with a over 100% increase in debt rates over the last 3 years. 35% is still relatively, to me, it seems like it's light, like maybe it should be higher. I don't know. But that makes sense to me that I also agree the next 6 to 12 months will be the best buying opportunity that we've seen in a long time. How will you know? I mean, at what point do you have, okay, I can fix debt at 3 or 5 years or 7 years, and I have at least a point and a half. I have 200 basis points. Like, at what point do you say yes? And of course, that includes rent growth and a number of other factors. But is there a general framework, Brian, that you have a general template that you would say now is a good time, or what are you tracking to help to when it's gonna really gonna go?
My my best indicator is like my market sentiment index, and this really is no numerical quantity of anything. The market sentiment index is the more you hear people negatively talking about real estate in a negative way, the closer you are to the bottom. And when everybody capitulates and just hates it, and they start saying things like, "Oh, this is like catching a falling knife. Real estate's toxic. This isn't coming back for a while," and those things are real key indicators. Now, we may not quite ever get there. We did get there in 2009, 10, and 11 when we had the bottom out from the great financial collapse. We had this significantly negative attitudes against real estate. This time it might not get quite as negative. So I'm looking at things like default rates. I'm looking at things like, these loan maturities. And so far, lenders have been kicking the can down the road to allow loan maturities to extend, maybe in exchange for some borrower cash to pay down loan balances a little bit. But what's going to happen is pretty soon lenders aren't going to be able to squeeze any more money out of the borrowers. The borrowers slash syndicators aren't going to be able to capital call any more money from their investors. Lenders are going to see that, things are going to look up soon. So they could probably take a property back now and be okay versus if they took it back 2 years ago, are they going to get half as much in another year? And as soon as a lender thinks there's any hope of being able to get most of their principal back, their sense of cooperation with these kicking the can down the road is going to vanish. And they're going to start forcing the hand of borrowers. And when that happens, you're going to have more operators in trouble, more sellers that are kind of panicking a little bit because they're running out of time, running out of money. That's going to be a really good time to buy. We haven't really quite gotten there, but we have started to see the door get cracked open just a little bit.
Great insight. I love those. I love those details. It's part of it. It's the market sentiment. It's the attitudes. It's what you're hearing. So you're listening and your intuition, and the other part of it's the hard data on default rates, loan maturities, and such. Yeah, we're gonna have you back on the show in 6 to 12 months to kind of go through this. And I know that there's going to be opportunities, and so we're looking forward to that. You guys talk a little bit about what you guys have. If people are interested in investing with you guys, if you're a credit investor, you can go to praxcap.com. But what do you have right now that if someone said, yeah, I want to learn more, I want to get connected, I want to see what Brian has to offer. What do you have, and what can they do?
The only thing that we've been doing over the last 2.5 years or so is buying real estate debt. So that's the one area where we've found a lot of success because interest rates have gone up, which means that we can get higher yield against cash than we could before, and we're lower in the capital stack, meaning we have a higher priority of repayment than equity. So it feels a little bit safer. If the real estate goes down in value, somebody else's money is in first loss position before ours. So I really like the real estate debt space right now. It's immediate cash flow that starts day one versus, like a value add multifamily where, 6 months goes by and you're getting a 2% cash on cash, and then a year and a half goes by and now it's maybe 3 or 4% because you've been able to increase rents. And then, 2 or 3 years later, you're kind of in that 6 or 7% range. Well, here we're able to get those kinds of returns immediately, just day one. So I really like that real estate debt space for now. It's been the only thing we've been doing for a while, and it'll be the only thing we'll have available until we find our next real estate opportunity, which won't be until we can find that the market's going to support it.
But in the meantime, you can go to praxcap.com and you can subscribe to their email list, right? And when they do send opportunities, if you're a credit investor, you can take a peek at that, praxcap.com. All that being said, Brian, we're running out of time. You ready for the lightning round?
Yeah, let's do it.
All right, knowing what you know now, if you could go back to your 20-year-old self with the one gold nugget, make sure to tell yourself to do.
I would say do exactly everything that I did, including make all the same mistakes, because every one of those mistakes that I made, whether costly or painful, made me who I am. And without them, I would not be where I am today. So just let it ride and just take the good with the bad.
Excellent. Question number two, top book you've recommended or gifted the most in the past year, besides The Hands-Off Investor, of course.
Gosh, none. I haven't had time to read books in years. Haven't given away any books. I like this book called Real Leaders Don't Do PowerPoint. That was a fun book I read about 3 or 4 years ago because it teaches you about how to present your ideas in a non-boring way. And as anybody in business would know, if you can't present your ideas, your business doesn't go anywhere.
Yeah, absolutely. By the way, that sounds like a great book. Do you know the author by any chance?
I have no idea.
Okay,
It's
well,
been too long.
look that one up. I'm gonna look that one up. That sounds great because I feel like Brian. Every time I see you speak at an event, you're like the best presenter. Like that just no nonsense, just lays it out, but also captures the audience in a real tangible way. So I'm gonna check that book out. Next question. Number one way that you're using Chat GPT or AI?
We use AI to assist us with setting our rental rates at our properties by calculating our vacancy rates, our notices from tenants on move outs, application volume, and all that sort of stuff to assist us with managing revenue versus occupancy. So that's the best way that we've used AI so far.
Excellent. Number one leadership quote or theme that you strive to live by.
Everybody likes to quote Warren Buffett's quote that says, "Be greedy when others are fearful, and fearful when others are greedy." And lately, I've been modifying this quote to say that be greedy when sellers are fearful, not just when buyers are fearful. That doesn't help you. Be greedy when sellers are fearful, and that's my uh, self modified mantra that I'm going by today.
Okay, got it. Can you expand on that? Like, what do you? Some people might say, what do you mean by that? So walk us through a little bit more on that. What do you mean by that?
Yeah, so buyers were fearful initially. They're like, "Oh, well, I don't want to buy real estate because the borrowing costs are so high." But sellers of multifamily, particularly, they've been sitting there going, "Well, my property's 95% occupied. We're break even cash flow. I don't need to sell. I'll just wait this whole thing out." But when their lender's knocking at their door saying your loan matured 6 months ago, either pay us $1 million to write your principal down to get another year, or we're foreclosing on you. And their investors are saying, like, we're not going to fund a capital call because, this is just throwing good money after bad. And then they think we're going to lose our entire LP investment. That owner is going to be really fearful of wondering how they're going to get out of the situation that they're in. And that's going to be a real good opportunity for someone that can acquire that property.
Perfect. Love it. You nailed it there. Next question is this, and it's actually, what is the next question on this one? The next one is, I think, the last question. I think we're down to the last question. Here it is. Here's the last question. So after all your success, Brian, scaling from zero to millions and doing over $1 billion of loans and exceeding the assets, like doing all the things you do, how do you best practice stewardship over ownership, right? And what's, like, fast forward, what's the legacy, for you and maybe a cause that you believe in to give back. You have such a unique background with serving as a police officer and then in real estate and with investors and all of it. Like, I'm trying to picture, like, what's the big thing for Brian when he's built it, and and what's something that is meaningful for you, Brian?
Yeah, well, stewardship over ownership to me, what that means is that you have to treat your investors' money better than you would treat your own. And, a lot of people, when they get into this business, they talk about, well, I want to build this business and I have 10,000 units, or I want to have 20,000 units, or, I want to have this or I want to have that. And what they fail to realize is it's not about you. Really, what you should be saying is, I want to be able to achieve a result for my investors. I've been buying real estate with investor money for over 2 decades, and I've never lost a penny of investor principal. And that's probably the one thing I'm most proud of, because that's what's most important to me. It's not important to me how many units we have or how much AUM, how much dollars of real estate we've bought. Certainly, we track these metrics because people ask. But what's important to me is I haven't lost anyone's money. That's stewardship over ownership to me. And as far as like causes that I really believe in, a few years ago, a friend of mine and I started a charity called A Hero's Home, and we raised money to give away a house free and clear of a mortgage to a deserving U.S. service member, and we accomplished that goal. It took us, like, I think 2 or 3 years to raise enough money to do it. But we did it, and it was incredibly fulfilling. So it was a lot of fun to do that. I really believe in supporting our law enforcement, first responders, and veterans.
Brian Burke, absolutely amazing. Every single time I have you on the episode, on the podcast. You've been on the Capital Gains Tax Solutions podcast, first time on the Build It to Billions podcast. You are always welcome here. Thank you so much. I want to encourage you to keep using your gifts of talents of being a great steward with people's capital, being a great steward of finding and listening to what the market's saying, to be able to help people create and preserve more wealth, help people to become passive investors because they can trust and work with Praxis Capital. For our listeners who want to get in touch with you, we wonder one last time, what's the best place for them to find you?
They can find us bigger at I'm sorry at praxcap.com. It's praxcap.com. They can also check out my book at biggerpockets.com/syndication book, or there's a link I think on praxcap.com.
Awesome. Thanks, Brian. I also want to thank all of our listeners for listening to the episode of the Build to Millions podcast. As always, we are here on a journey with you just to guide successful entrepreneurs, investors on their journey from millions to billions. And we believe that the key to scaling your business and compounding your wealth starts every single day with a mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal to help you scale and compound your wealth and life so you can give more, all of it away to help MVPs, people who perhaps are even serving first responders or in the military, or those that are looking for an opportunity to get a chance to compound their wealth here. And so whatever it is that is meaningful to you, I encourage you to go after that and help more people build your business from millions to billions so you can help more of those people that you care about most. I'm Brett Swartz, and I appreciate everyone listening, watching. Please subscribe, rate, review, and we'll talk to you again real soon. Bye now.